Hey guys, welcome to episode 1 of my dividends portfolio journey. My dividends account is on the finance platform called M1 Finance. I discovered this through a friend and an influencer I look up to a lot who use this platform, and I'm just a real big fan of it. I love how it's so easy to just see everything from a bird's eye view. It also dive in more direct to see exact stats from certain sections as well. All right, so I currently have $825 in this account. And I started this account on June 21st. So let's see, that's the 6th. Today is the 10th. So I've been doing this a little over 3 months. I didn't want to start my videos like with $1 in my account, but I want to start them before I hit 1,000 in the account for sure. So yeah, I'm at $825 in value right now, and being straight up with you guys, right now I am down by 8.70% return, down at 51.72 right now. As you can see, the market has brought me down $57, just market movement, the stock's going up or down. But I am in the green in earned dividends. I've earned $5.61 so far in dividend payments. Let's see if it dives in here. Kind of not really. All right, 561 there. And I have 32 cents buying power, which is power to buy more stocks. If I would like, that 32 cents is from a recent dividend payment from O Realty. So here is my pie. And at first, seeing that it's down 8.70%, you might be like, well, why are you putting money in still? How are you seemingly so enthusiastic about this growing? Well, that's because over time, my chosen investments have proven to go up. If I hit share pie real quick, if I hit share pie and I hit copy and I go over here and I go ahead and paste it in. Let's see if this will load here. This will show you what my account's value would be at if I had started it in 2022. If I had started it all the way back to, I think, 2018, if I remember correctly. Let's see here. It'll go back to 2022. But we could see that if I had started investing in May of 2022, everything the same way my portfolio is now, same funds, and I just started earlier, I would currently be up 8%. Even just since October, up 12%. So currently, in the last month, let's do quarter. Quarter is it's 3 months. So since I started, down 6%. In the last 3 months, these chosen investments are down 6%. But had I started earlier, I'd be up 12% or up 8% in the 3-year span or multiple year span. So this is why I am still very passionate about this fund, and I am not worried that it is down temporarily by about 8%. This is the time to buy, time to get things on sale. Anywho, these are my different sectors. I have a core growth sector. These are really strong stocks such as schd, VYM, and jepi. Really excited about these. These are ETFs that divide your money into a lot of different stocks. So I have a lot of diversification just by having these three. And yep, excited about those. If we go back, I also have a fund called Financials, Grocery, Restaurants, REITs, which is real estate, Industrials, Tech, and Energy. As you can see, my energy is actually up significantly, almost 10%. Tech is down just a bit, basically break even with the tech sector. Industrials are down a lot. Real estate's down a little bit. Restaurants are down significantly. That's my biggest loser so far. Grocery is also neck and neck with restaurants for biggest loser. I think this is in part because people are just, they're getting stressed when going to the grocery store. All the rates are rising because of interest rates. And groceries are getting more expensive. Restaurants are also, people are choosing to be, I think they're eating out less. I think people are trying to cut their spending whenever they can. So naturally, there's some pressure in these sectors. I'm not filling it up with an excuse as exactly why. I don't know why. I think, as you can see, since most every single sector is down, the market is just down in this last quarter. Just go look at any stock. You can, like, heck, even tech is not even break even for me. Um, Energy, things like gold stocks, maybe bonds, also oil, crude oil, which is the energy. All I have in energy is ExxonMobil. Stuff like that's going up because oil's rising, the cost of gold is rising. When the market goes down, those things go up. But yeah, these are my different funds: core, financials, grocery, restaurants, REITs, industrials, and tech. Without going into every single fund, let's just look at a broad picture of my holdings. Here are the 19 positions I have. I think that having 19 positions is a lot. I do never want to pass. I don't want to hit 20. If I do hit 20, okay, but I don't ever want to pass 20 positions. I want to have a small account so I can really focus on certain funds that I have. If I diversify too much, I feel like I'm not going to be able to really pay attention to what's happening with each individual stock. So I'm at 19 right now, but I do want to trim this down in the future. You might be thinking, well, why do I have all these stocks if I just want to sell later? Well, I want to kind of give it some time because I'm passionate about all these stocks. But as time goes on, if there's one that's like really just barely breaking me even, one that I'm not as passionate about, I probably will trim it off. But starting out, I've got schd, VYM, O Realty, MasterCard, JP Morgan, Texas Roadhouse, McDonald's, Target, jepi, Deere, as in John Deere, ExxonMobil, Caterpillar, Hershey, Microsoft, Kroger, Costco, QQQ, which I'm about to eliminate from the portfolio here in a little bit. Only have a couple dollars in there to make it 18 holdings. SMH, which is a semiconductor ETF, and Apple. Now, considering I'm about to get rid of QQQ because I want to be more specific on Apple and Microsoft in my tech, I don't need to diversify into QQQ. It'll bring you down to 18 positions. And then if you consider that I have 3, 4 ETFs, I really only have 14 specific stocks at that point. And if we go back to my portfolio, you see that these core growth stocks are a 45% weight on my portfolio. So even though I have 14 specific stocks I'm banking on doing well, I have almost half of my entire portfolio just going to strong, time-tested growth stocks to kind of even out and minimize my risk. In another video, I will go kind of in depth on why I've chosen these specific stocks and how they've individually been performing for me so far. But this is a kind of a brief overview of my M1 dividends portfolio. And like I said, I'm not being discouraged that it's down right now. It was down like just 6% a couple of days ago. It's been down 11 at one point. It goes up and down. There's a lot of swings. I have a lot of different positions, a lot of stock positions rather than ETFs. So I am subject to some volatility for sure. But over time, we'll see this market gain go up, as well as this earned dividends going up, closing the gap between the two, reducing those that loss. So if we go, also one more thing I wanted to point out is what my dividend earnings rate is. If we go back to that the share link that I sent out, it'll cover those grounds. My portfolio has a 3.70% dividend yield. I'm really happy about this yield. This is really high. It's close to 4% while still having a lot of growth potential. At one point, it was like 2.8%. That was before I added jepi, and I added a decent amount of jepi. I want to say 12% weight on jepi in my portfolio, which I understand is a lot considering all my other stocks are about 5% and jepi's 12%. But if we look at jepi's chart, jepi stock, it is been solid. If we look at the last year, up 2%, 5-year up 6%, max time up 6% all time. It's just your money has held around the same amount, opening at 50, going all the way up to 60. I mean, barely out of 50s, all the way down to 51. Your money's basically stagnant, and you're being paid with a really high dividend yield of about 10-11%. So sure, people will say, oh, well, it's not as safe as just keeping your cash, or not as safe as putting it in bonds. But I'm pretty confident in this last 3-year yield. Obviously, we don't have a ton of time to base this off of, but this is a good holding of just passive income. My money's going to stay fairly neutral to market swings while giving me that good high dividend, because I was looking to increase my dividend yield because it was only at 2.8, which was okay, because chasing high yields is not a good thing to do, and I can go more on that later. But jepi, I feel like, was a pretty safe way to add a higher yield into my portfolio with pretty low risk. So my dividend yield's up at 3.70 right now, and my expense ratio is super low at 0.07%. This means that 0.07% of my money is being paid annually away in fees to different ETFs. So to put that into perspective, 0.07% of your money is 7 pennies to the dollar. 70 cents to every $10, $7 to 100. If I'm thinking of this correctly, correct me if my math is wrong. Where's my phone at? Let's do some math here. 0.07 0.07% of 10,000. Yeah, 0.07% of 10,000. For every $10,000 I have in this fund, I'm losing $7 in fees. $7 for every 10K. Just $70 when this account is at 100K. Just 700 when there's a million in the account. So 0.07% is really low in fees. I'm really happy about that. And yeah, I'm really just excited to keep you guys up on this journey. I plan to make weekly videos about this portfolio as of now, and seeing how that goes, I might decrease the frequency or increase. But yeah, I'm just really excited and passionate about starting this journey with you guys while I have only a small amount of money in the account, and hopefully building it up to other YouTubers that I watch that are have 8,000, 80,000, some even at $500,000 in their account. So if you guys are watching this, leave a thumbs up. You've been in the journey since day one. I'm super excited to just see how this journey goes along. Thanks for joining me. Peace.